All right, next we're going to look at the price and output decision for a monopolistically competitive firm. It's going to look very similar to what we've seen already with monopoly. So the reason for that is because, like the monopoly, monopolistically competitive firms also have a downward sloping demand curve. So this is going to look a lot like the case for monopoly that we just saw in the last chapter. Why am I out of focus there? There we go. And so again, like every type of firm that we will look at, all firms maximize profit by producing the level of output where marginal revenue equals marginal costs. So we've seen that already twice now with perfect competition and monopoly. So this is the rule, the profit maximizing rule, regardless of the type of firm. So nothing's changed there. Now, in the short run, it's possible for these types of firms to make economic profits, just like we saw with perfectly competitive firms. And we're talking about economic profits, right? So profits over and above the normal rate of return, or in other words, what's beyond what is necessary to keep that firm in the industry. And as well, losses are possible too. But in the long run, there are zero economic profits, and this is because entry and exit is so cheap. It's so easy for competition to get in that any time that the industry is experiencing positive economic profits, new firms enter, which basically erode the demand of competitors, which slowly bring profits down, and that pressure continues to exist until profits are zero. And then the opposite is true if firms in the industry are losing money. Over the long run, firms that are losing money will exit very easily because there's a low cost of exit. And as they exit, that increases the demand of their competitors, which brings their profits up, or basically brings them out of losing money until there are zero economic losses. Okay, so we have a very similar long-run picture here compared to perfect competition, where we also saw that long-run economic profits are zero. All right, so what does this all look like in a graph? Okay, so we've got our curves here. Again, downward sloping demand curve, a marginal revenue curve, which is below that, and then our average total cost curve and marginal cost curve. So again, the profit maximizing quantity is where marginal cost equals marginal revenue. So where do those intersect? Right here. That's the profit maximizing quantity. And then in order for the firm to determine its price, it just goes from that quantity up to the demand curve, and that's the price that it can sell that quantity at. So this whole process graphically looks basically identical to monopoly. And then in order to determine profits, we've just got to go from that quantity up to the average total cost curve. The difference between price and average total cost is the profit per unit in this case, since price is above cost. And then if we multiply that profit per unit by the number of units produced and sold, then we get total profit, which is that blue area, that blue rectangle there. And then, of course, if the firm is losing money, we've got this sort of picture again where recall that when the average total cost curve is up above the demand curve, the firm is going to lose money. Whereas if it drops down below the demand curve, the firm is going to make a profit. So that's still true. And so same thing, right? Profit maximization is the same as loss minimization. So the firm is still producing where marginal revenue equals marginal cost, goes up to the demand curve to figure out the price it needs to charge to sell that quantity. And then in this case, because average total cost is higher than price, the firm is losing this amount per unit. And we multiply that loss per unit times the number of units, and that gives us total loss. Okay, so this is basically exactly like monopoly. And then here we have the zero economic profit condition where average total cost at the profit maximizing quantity is exactly equal to the price. So price is exactly equal to average total cost. So the firm is receiving exactly what it costs to produce, right? So zero economic profit. And this is basically when the average total cost curve just barely touches the demand curve at a single point. And that's the point at which the profit maximizing quantity is. All right, so here's a question. If both a monopolistic competitor and a perfect competitor make zero economic profit in the long run, how are they different? Well, hopefully you can say a little bit at this point about how they're different, at least. The main difference is the demand curve that they face, right? Perfect competitors have that flat, perfectly elastic, horizontal demand curve, whereas here, monopolistic competitors have a downward sloping demand curve, okay? And that's actually why monopoly is part of the name. It's because, like a monopoly, they have a downward sloping demand curve. All right, so here's graphically the difference between perfect competition, right, with that horizontal demand curve, perfectly elastic, and monopolistic competition. Now, the other main difference here is that in perfect competition, in the long run, the firm produces at its minimum average total cost. So it minimizes costs in the long run as a result of its zero economic profit condition. Whereas with monopolistic competition in the long run, where there are zero economic profits, they do not produce at the minimum of average total cost. Their costs are slightly higher even in the long run when they make zero economic profits. So this is actually related to the efficiency of these different types of markets. So perfectly competitive markets are the most efficient markets because they minimize cost of production, whereas there's some level of inefficiency here in monopolistic competition because these types of firms do not minimize their costs of production. All right, so in perfect competition, the long-run equilibrium occurs where average total cost is minimized, leading to the efficiency. This does not occur with monopolistic competition. Now, some have argued that this is not necessarily a waste of resources, as the added cost arises from product differentiation. So basically the idea there is that, yeah, okay, maybe they're not minimizing cost, but the benefit is that we have some variety, right? It's not like the only type of pizza we have is Pizza Hut pizza, right? We have a variety of different types of pizza. We have Papa John's, we've got Domino's, we've got Little Caesars, we've got different types of take-home frozen pizza, right? And then, of course, you've got your gourmet or other types of pizza restaurants, Mellow Mushroom, for example, right? So yeah, we give up a little bit of efficiency in terms of cost minimization. But the benefit is that we have a variety of products to choose from, and so it's not really a big deal. Now, Chamberlain argued that it's rational for consumers to have a taste for differentiation, a taste for variety, and that consumers willingly accept the increased production costs and therefore the increased prices in return for more choice and variety of output. So think about yourself, right? What would you prefer? Perfectly competitive industries and all types of things that you, all the types of goods you want to buy, or would you prefer a monopolistic competition where there's variety? I think, like myself, you'd prefer some variety, right? All right, let's wrap up this section thinking about a hypothetical. What if the government decided that monopolistically competitive prices that exceeded marginal costs constitute social waste and banned such waste from occurring? Well, what would happen? In the short run, firms would earn a short-run economic loss as the price would be less than the average total cost of producing any quantity of output. And in the long run, some firms would exit the industry while other firms would reduce the costs they incur by in producing differentness. So both the number of firms and the variety of products would decrease. So this wouldn't be a very good government policy. It would hurt the economy and these industries, and it would lead to fewer choices for consumers.